Hello, traders. James Stanley here. Gold has been in a parabolic push ever since Jerome Powell's speech at the Jackson Hole Economic Symposium. Gold broke out of a bullish formation, rushed up to a fresh all-time high, and continues to push into a fresh all-time high. The next week is huge. I'm shooting this on Wednesday. Tomorrow is the US CPI report, and then next Wednesday is the Federal Reserve rate decision, with the Fed widely expected to start a rate cut cycle that could amount to another 150 bips in cuts to the end of next year. So a lot of questions come up on a move like this. I want to use this video to address a few of them. One, what's behind the push? I want to look at this from a fundamental perspective. I want to look at this from a technical perspective because it's once we ascertain the drivers that we can start to look at what might produce some element of change. Speaking of the next question, what could lead to change? I think there's a technical backdrop that's perhaps more important, but there's also a fundamental component here that needs to be addressed, especially with the drivers we have ahead of us. And then I think most importantly, the question that should be on everybody's mind, how can a trader handle or approach it? When we get one of these parabolic-like moves, it has a tendency to stoke emotion in both directions, where you have the FOMO driving the chasing move, you have the cynicism or skepticism driving reversal potential. Emotions and trading are dangerous when mixed together. In the long term, trading is a psychology game, and a move like this could make it really difficult to keep that into check. I want to address this from a couple of different ways because I think there's really only a couple of ways to go about it. Maybe a third way, but I'm going to address all three in this video. So let's get onto the chart. First and foremost, what's behind the push? If we look at gold, really, this has been trending higher since February of last year. And in my opinion, gold has this incredible way of trying to look around the next corner. It might not always be right, but it tries to look beyond what's the initial stimuli. And what I mean by that is if we look at gold longer term and we go back to like the financial collapse, you'll notice that as the Fed is getting aggressive with QE and zero interest rate policy, gold goes vertical and continues to rally for a while until eventually topping out just below the 2K level in 2011. Now, at that point, the Fed was still pedaled to the floor with accommodation, but it didn't matter. It's like markets were looking past that and saying, okay, well, what's next? Is all this inflation or is all this stimulus going to produce some element of inflation? Because setting long gold, especially after a massive rally, not an attractive way to set through that type of change. And lo and behold, that 2K level never gets tested or didn't get tested there. It doesn't come into play until COVID. COVID, again, another situation where the Fed goes pedal to the floor with stimulus, finally producing that 2K an ounce test. But again, it was like gold is looking around the next corner and saying all this stimulus is eventually going to amount to inflation. And all of a sudden, that gold rally stalled right at that 2K level. 2K held as resistance for 3.5 years. What finally started to change this was last year. There was a comment from Chicago Fed President Austin Goolsbee that I think was very telling as to what was behind the push in gold and what remains behind the push in gold, which, to my mind, is the prospect of currency debasement. In early 2024, gold had already rallied. It started to hold above that 2K an ounce level that was resistance now being turned into support. There were 2 days last year when it actually closed below that level, and it was around a US CPI report. A US CPI report on February 13th sent gold below 2K for the first time that year in 2024, and it closed below that level. A day later, we had another close below that level, but that's when the comment from Austin Goolsbee, the Chicago Fed president, came out, and he said, let's not get all flipped out about one inflation report. It wasn't one inflation report. The prior few had also been well above the Fed's target, and I believe a couple had even printed above the expected. It was at that point where the Fed cuts that they had highlighted in the dot plot matrix in 2023 that markets had priced in, very similar to the way that we priced these in today for out to next year, when those came into question behind that CPI report. But when Goolsbee shrugged that off, seemingly dismissing data that didn't suit what they wanted and instead pushing their hope to be able to cut rates, gold went vertical and didn't really stop. It continued to rally throughout the year. all the way until we got right here installed just inside of 2,800 right around the election. Now, if you're following this from a short-term chart, I'm going to get to this when we get to the strategy element. But if you're following this on short-term chart, it's going to look like an aggressive sell-off or pullback. But, reality is this was just a haircut in the broader bullish trend with a low setting just a couple weeks after the high had come into play. And then it's right here when bulls come in to show a higher low, and you can see that still that latent bullish anticipation even after this rally. Now that helped to set up a symmetrical triangle. Symmetrical triangles normally are a non-directional formation because it's both lower highs and higher lows. But when you consider the context and the fact that there was this massive rally that brought on a one-sided move that largely was driven by positioning demand rather than or an onslaught of more and more demand, the fact that we only pulled back a bit and then saw a higher low, that bullish anticipation shows you that there's continuation potential, which is what took over in early 25. That bull pennant led to a strong resumption move all the way until we hit another psychological level at 3,500. This time, 3,500 served a similar purpose as 2K, where that was the line in the sand that bulls just could not cross. But what was behind the push was that dovish Fed, even in light of strong inflation. And that's what started to take hold again. From a technical perspective, you could see this aligning very well as markets build in the expectation or the anticipation for lower rates. As you can see in this rally here, as you see in this rally earlier in the year, as you see in the more recent rally, as this thing's gone parabolic. And that helped to show the technical formation of these bull pennant formations. So, thereby, what could lead to change? Well, if we're seeing a market rally on anticipation of the Fed remaining dovish or cutting rates even with inflation high, I think there's two things that could produce change. We could even look at this recent history to examine how that might play out here. First and foremost, if we do see the seeds of inflation growing, then I think we could see markets starting to price in the probability of the Fed eventually turning or shifting at some point down the road. It's neither here nor there now because markets are so widely expecting rate cuts into the end of this year and next. But if we see that inflation respond with a jump after the Fed cuts rates, I think there could be rationale for gold to pose a larger pullback type of setup. But it's important to remember, fundamentals aren't a perfect push point for price. It's supply and demand that is. Now, fundamentals can often induce supply and demand, but I think an easy way of saying this is very similar to what we saw in April. If anybody willing, able, and ready to buy is already long, even the best news in the world is going to be a challenge at pushing prices higher. And that's what could lead to pullbacks. And then as prices pull back, even in the face of good news, then you have the deduction of prices going down even with good news that could compel more selling and a deeper pullback. Very similar to what we had seen here from April and into mid-May. So, being in a massively overbought state, what happens is the litmus for continuation just goes up more and more. To get this breakout or to get a justifiable backdrop behind breakout continuation, we're going to need to see the Fed as really dovish because markets right now have that proverbial rubber band pulled all the way back. It doesn't mean the trend has to reverse, though, and that leads to the trading strategy element. With a parabolic-like move, there's really just three possible ways of moving forward. One is you can try to fade the move. You can try to look for the reversal. That's a challenge because you're eventually swimming against the status quo. But the benefit behind that is if you do hit it, very similar to this that started back in April, if you do hit it, the move could be large, very large considering the possible risk outlay. So while the winning percentage on a reversal strategy might be expected to be lower, the risk-reward, or the reward to risk, could be seen as higher. And that's, I think, the way you have to justify a strategy like that because you have to expect that the status quo shifting or changing is probably going to be the exception versus the rule. Now, to do that, you need a good area of resistance, similar to the way 35 had played in April. And then you need to be able to stick to those guns to where if it does get broken, you have to call it what it is. It's wrong. And you don't keep throwing good money after bad, hoping that it ends up being right. For the reversal, I think the way that I prefer to look for these to play is to look for an area of resistance, to look for a lower high that could then give me some scope for managing risk on that setup. And from that, I could then factor it to get an idea for what size of move I need to find or look for to justify that risk outlay. So if I'm looking for, say, $10 of risk, is $20 of reward worthwhile? A 1 to 2 risk reward ratio. I need that to hit a little over 35% of the time, not including spreads or commissions, to look for a positive EV over the long term. Do I think that there's a 35% probability of a pullback hitting 2x or $20 if it's a $10 risk outlay? I think that's the math you got to look at if working for these reversals. Right now in gold, I have this setup or this Fibonacci projection that I think could be adapted into that type of argument. I'm essentially taking the move that developed here in June. And the reason I'm keeping this on my chart or have it is the way the 1618 had done a really good job of holding this intraday high. It gave a little bit of a pullback, a short-term pullback, even though we were still within the parabola. Right now, the 200% or the 100% measured move of that is coming in as resistance, and that's what's helping to set a possible lower high right now. It's still early because we don't have a lower low to work with. If we get a lower low, then we could say lower high, lower low, deeper pullback setting up, then 36, and then that 35.77 level, those could then come into play. But that's how I could look for a reversal type of setup. That's not something I'm interested in right now because of the fundamental push behind gold, and I don't have any foreseeable way of expecting that to change. Instead, I'm taking the approach of only looking bullish, only looking topside, only looking for continuation. And instead of trying to get cute by playing counter trend, waiting for pullbacks to see if we get some of these bigger levels or areas of support developing that could then substantiate trend continuation setups. On that front, there's two ways to look at longs. The first is not something that I do, that's breakouts. The reason I don't do breakouts goes to something I'll talk about here in a moment. But with breakouts, you could essentially look for breaches of fresh highs. In this case, you could even use this possible lower high and look for a break above that to look for trend continuation. And then maybe even using that as an initial target to justify whether or not the setup is attractive. The question then being, can you manage risk inside of that to make those numbers work? But ultimately, it's the prints of fresh highs, such as we saw here at 36, or prior at 35.77, or before that down here around 3,500. It's those prints of fresh highs that trigger into breakouts. The reason that I'm not a big fan on that is because over the long term, trading is psychology based. And if I'm allowing my FOMO or my fear of missing out, my excitement to get the best of me, and it doesn't work out, that's something that I'll wear. I'll think of that. It'll stay on my mind. It's not something that I'm going to easily be able to dismiss. But if I take the next approach and it doesn't work out, I still feel good about it because I stuck to my guns. I instituted my strategy and I did what I think is the best way of moving forward, which is trying to be more patient. Now, there's two different ways I'm going to show you to do that. By being more patient, it takes something like we've had here with this massive parabola, and I could do this on a shorter term basis by taking these swings of higher highs and higher lows and higher highs and higher lows. And I could say, all right, well, I need to pull back here to 3,600 with some show of support to give me an open door for continuation. But what I need for a show of support is I need a closed body candle with a wick through or at that level to show me that bulls are coming in to defend that price and it's not just something theoretical. I could do this on a shorter-term basis. I could do this on a longer-term basis. But we have this recent sequencing of higher highs and higher lows, and it gives me like a roadmap to work with. 3,600 is an obvious area to look for. 35.77 is, I think, another area of interest. You could see where that happened on a shorter-term degree. We had the high here, the breakout, the test of 36, the pullback that holds at 35.77, then the higher low, and then rally. But also might have to be a little bit more accepting of an imperfect scenario, very similar to what we had here. We had that Fibonacci projection setting resistance. We get the pullback. Notice bulls responding here before we even had a test of that 35.06 level. That underside wick, it shows me the bullish reaction that I was looking for. So maybe I don't get a perfect print right at support. Entry becomes a little bit messier, but on the same token, I know where to manage the risk. If that low gets taken out, or maybe if I want to get it on the other side of that low, I know the reward side of the move that I need to justify that risk outlay. And at the very least, I have some numbers to work with, and it's not just theoretical at that point. I think more attractive, and this is the one that's less attractive for the people that normally watch my content, is being patient and looking for a legitimate pullback on like a daily chart. It's not attractive to a lot of people because you'll miss out on the excitement. You got to sit on the sidelines where everybody else seems like they're having fun. But you get in enough of those imbroglios and you realize it's not all fun and games. Instead, you wait for some element of support to show at prior resistance. You look at these closed daily candles. You see buyers respond here, then respond here with a higher low. I looked at this setup in a webinar on May 16th. It's out there on YouTube, where I was looking for this higher low to hold right at prior resistance, and that led into a bullish continuation move, a retest of that high. And then another higher low. And then another higher low. And that's what helped to build this second bull pennant that eventually breaks out into a big picture parabola that's volleyed all the way up to that resistance. I know, it's not as attractive, but you gotta own what it is. The risk is you might miss out on the trade. You might be sitting on your hands the whole time. But the upside is even if I do wait and I get the pullback and I get the underside wick showing support right at that resistance, I put my stop on the other side of that wick and it doesn't work out, I'm not beating myself up over it. I did what I wanted to do. I looked for the trend to continue. It just didn't hold. And now maybe we have a deeper pullback scenario to work with because I got a lower low. Maybe I could get a lower high, and then I could look for that to go the other way. But at the very least, I could concentrate that risk. And it's not going to be a costly endeavor for me. It's not going to be something that I'm going to notice in my account when I pull it up the next time because I just lost a small portion versus looking for a wide risk outlay that I might need on like a breakout setup or something that I was chasing. Again, I know, not as attractive to a lot of people that want to play in the middle of the volatility. But that long-term patient approach is what I've personally found to be most rewarding because you get these elements of like support at prior resistance that could lead into these long-term massive bull runs, and that's something that you can feel real good about. And at the end of the day, like I said, long-term trading success is about psychology more than it is about guessing right or wrong. That's what I have, folks. I'm going to be following gold very closely over the next couple of weeks as we have CPI tomorrow, FOMC next week. And this, I think, ultimately is going to be the push point, those rate cut expectations that are going to play a big role in whatever happens one way or the other. But that's what I have for today. Thank you for your time. And as always, happy trading.